Hi, this is Brien Lundin, and you're watching Market 1 Minute. I'm here with Marin Katusa. Marin, you are the New York Times best-selling author of The Colder War and a hedge fund manager. Your book has made a lot of waves in the investment world recently. Can you kind of explain the basic premise that you're putting forth?
Definitely. It's basically Vladimir Putin's become the leader of the emerging markets, where nations such as China and other emerging markets are working together in concert against the interests of the West, which is led by the Americans. So we've seen the drop in oil, which we cover at the end of our book, and basically we see for the next little while the US dollar staying strong. By definition, we see the deflation in the resources because of the common denominator of the US dollar, and then eventually the pinch point will come, and then the inflection point will happen in the resources. And Putin will fight this war, and the emerging markets will fight it not via bullets, but through energy resources. China needs a 50-year long-term supply to keep the dragon moving.
So you've anticipated the drop in energy prices in your book, and how does that change the premise to the degree that energy prices have dropped?
I must say it's happened a lot faster than I expected, but what it really is going to change is innovation by a necessity. And you're going to see a lot of changes that people wouldn't expect. Will there be a Strait of like black swans, like the Strait of Hormuz shutting down, Strait of Malacca? Will there be a revolution in Saudi Arabia? Will Russia go down, which I don't think it will, but a lot of people will. Will Putin lose his power? Not in the next few years, even at current oil prices. So there will be black swan events. There's so many out there, but which will be the catalyst of the change?
Well, that runs counter to the consensus right now. Now, Saudi Arabia's price war in oil is supposedly designed to dampen the frack industry in North America. And it's having that effect. But really, North America, along with Saudi Arabia and perhaps Kuwait, are the lowest cost producers. So isn't that price war really going to take out all of the higher cost producers first?
Yes and no. First off, you look at the Canadian oil sands in Canada. Everyone just assumes they're a high cost producer. But there's so much infrastructure already built in there that the existing production that was set in the 90s and the early 2000s, and even in the 80s, is economic at $25. You look at the Russian oil fields. We're talking about wells that produce 2-3 barrels a day. There's tens of thousands of these wells. They can keep producing. So what it's about is market share. The Americans went from being the #1 customer of Saudi Arabia to now a competitor, because the Americans are exporting NGLs and condensates. So what is really going to happen here? You really see a three-way war between Saudi Arabia and the other Arab Gulf states versus the exports of the shale revolution, and also Russia and Iran.
So the big fear that you see most analysts and most investors having right now is that Putin is going to be desperate, that this price war that Saudi Arabia has begun is really going to make him more desperate, back him into a corner. But you're saying that he has more staying power than most people really believe.
Much more than what the people in the West. You have to understand the Slavic mentality and how they really support Putin. And remember, the average Russian today is much better off than he was 20 years ago. That's something that the West can't fathom. What this really has done, the sanctions against Russia, has pushed Russia closer to China. It's pushed the fast forward button on their future together. And the Chinese need a long-term supply. Hence why the biggest construction project in the world is the new pipeline. That's phase 1. The currency swaps going on between Russia. And remember, yes, oil's dropped 50%, and that is painful for all petrostates. But the ruble has dropped just as much. So the Ingo is equivalent to what it was before in rubles. So, the weakness of Russia, I'd be more worried about the debt implosion that's going to come in the next few years in the shale producers.
The Russian deal with China for natural gas, was that for show, or is there a reality behind
Oh, that's
that?
a reality. If you really look what's going on right now in Europe, Putin's now going to start rattling the saber by saying, wait a second, we're going to cut off the gas supplies through Ukraine and we'll ship it down to Turkey. And now the Europeans, do you think Germany's going to allow them, depending on the Greeks and Turkey, to get their natural gas? So now Germany's going to have to rethink their sanctions. The amount of gas that is eventually going to go to China within the next 10 years is going to be more than all of the gas that goes into Europe.
And it's not going to be priced in dollars either.
It's not going to be priced in dollars.
So it's really a currency war as well as energy.
Definitely.
Well, Marin, thank you for appearing today. The book is The Colder War, a New York Times bestseller. A wonderful thesis you're putting forth, and I think it's really made a lot of waves in the investment world. Thank you.